So what do we know about private equity multiples in Africa? The Bright Africa report details the levels that transactions are occurring at on the continent compared to other parts of the world. This chart shows the average multiples paid by year. So we've got year along the bottom. So we've divided all the multiples on all the transactions into buckets of years. So it shows the average multiples paid by year in African private equity deals. And it actually splits the multiple as well into the part that was debt and the part that was equity. So the blue bars here along the bottom are your debt components of your EV/EBITDA multiple. So that's your debt to EBITDA multiple. And the orange parts are your equity. So in general, African private equity deal multiples have been lower. And it's useful just to for me to tell you what these other bars are, or the other lines are. At the top here, we've got US and Asian EV/EBITDA multiples, and the bottom lines are the debt multiples in the US and Asia. And this is Asia excluding China. So what we can see is that debt multiples are quite a lot lower in Africa than they are in other parts of the world. I think we average, over this period in Africa, we average around 2 times EBITDA as a multiple. In debt terms, compared to the average in Asia of around 4 times and an average of around 6 times in the US. So there's a far lower leverage that's used in African private equity deals than are used in other parts of the world. What's interesting here from a US perspective is how post the financial crisis, use of debt in deals is definitely trending back up again. There's lots more debt coming back into US private equity deals, which hasn't really happened in Asia and certainly hasn't happened in Africa. In fact, this has been pretty much a downward trend in the amount of debt that's used. And to a certain extent, that's some of the transactions moving away from South Africa, where the larger deals are, to the rest of the continent where not much debt is used. So the use of debt in Africa was much higher here back in 2007, where these large deals were still being done in South Africa. However, since then, debt levels have reduced and have not really recovered, as I said. So if we break out these deals and we split them into buckets of where the multiples are falling, we've got 4 categories here of multiples falling below 2.5 times, from 2.5 to 5 times, 5 to 7.5 times, and above 7.5 times. From a global perspective, most deals fall into this 5 to 7.5 times category. But we're finding a very different story in Africa. And we've only really been able to speculate as to why this is. And I'd be interested to hear any opinions after this. But what we've seen is that a lot of high growth, very sort of high prospect deals are falling into the slightly higher category of above 7.5 times. But your more normal deals tend to fall into a slightly lower category. And we think this is because of the higher risk perception in Africa, where investors looking at deals across different markets might only be comfortable to pay a slightly lower price for a similar deal in Africa than in other markets. However, as I said, many deals still fall into the highest category that we have, the above 7.5 times. So it's an interesting one, and only around just over 20% of deals happen in this category, where around almost 50% of deals happen in a global context. When we look by company size, this is quite an interesting trend. Globally, the multiples paid trend up based on company size, and the story that we found in Africa is actually very, very consistent with this, although at a slightly lower level in each case. So for deals that happen in this 0 to 25, this is on enterprise value of deals. So deals with an enterprise value of less than $25 million, we're seeing happen at around 5 times through Africa. But on average here, African deals average about 12% lower than they are at globally. I mean, this idea of the extra risk premium for Africa is played out quite clearly here, with every category actually having that risk premium slapped on top of it. What was interesting for me doing some of this analysis is that even in the large category, these $100 million companies, which are large by anyone's terms, even those companies that have managed to make it big in Africa are still subject to this extra risk factor. Coming back to debt to equity ratios, We've had a look at the capital structures of each of the deals in our data set, and what we've found is that there's very low levels of debt used across all of these buckets, and we've used the same buckets as we have in the previous slide. And what we see is that only around 20% of the capital structure is debt in the smallest deals, and that goes up to around 30% in the largest deals. So these, I think we'll all agree that these are very conservative levels. And when you compare them to global use of debt, which ranges in the small deals from around 40% to around 60% in the largest deals, while the trend is the same, the attitude in South Africa looks very conservative. And there's some good reasons for this. I think the access to debt is a lot more difficult in Africa. And there's risk aversion. There's general risk aversion. And anecdotally from GPs, it seems like GPs don't believe the use of debt is as necessary as it is in other places in the world. There's a lot more reliance on the fundamental drivers of company growth, or growth of return rather, as in company growth, and the general development of markets that are going to pull up the value of companies. So the last split of this that we did was to look at the multiples of private equity and listed equity in the different regions of Africa, with some interesting results. What we saw was that South Africa, or Southern Africa, which is mostly represented by South Africa here, is the cheapest of the regions, which may be because of the lower growth that's forecast for this region. I had thought perhaps it would be balanced out by the lower risk that's in South Africa compared to other parts of the continent, but it is what it is here. And we can see that in South Africa, the private equity multiples are at a discount to the listed markets, which is what we'd expect. Investors sacrifice liquidity when they go into private equity, so you would expect multiples to be a little bit lower to compensate investors for that. Looking at West Africa, it's certainly the most expensive of the regions, and I think that goes back to some of the earlier slides where we saw how strong the growth has been, how much money is piling into places like Nigeria and Ghana, driving West Africa. But again, we see that private equity multiples are lower than the listed equity multiples in that region. In North Africa, a very similar story. Despite the Arab Spring, there are high, medium, and longer-term hopes for that region. And again, private equity multiples come out lower than the listed multiples in that region. The anomaly here is East Africa, and these are the numbers that I'm least confident in East Africa because they're the smallest part of our data set. As I mentioned earlier on, we haven't seen as much activity in private equity in East Africa as we have in other parts of the continent, and we hope that'll change with the formation of the East African Venture Capital and Private Equity Association, and it may just be a matter of data coming out into the market as well. But the anomaly there is that private equity multiples appear to be higher than listed multiples in that market. So it's clear that African economies are going through a period of high growth and development. This economic growth is accompanying the broader trends of the reduction of conflict, the spread of democracy, urbanization, and the beginnings of a middle class in many countries. While Africa has certainly not yet achieved the kind of growth that has been seen in China and India, the continent has been widely forecast to be the world's fastest growing region over the next decade, as many of the macro themes translate into greater economic prosperity. African and global investors looking to tap into this growth are looking to the different investment alternatives offered on the continent and are weighing up the pros and cons of the available asset classes. African listed markets have very different levels of quality with low number of listings and low liquidity outside of the large exchanges of South Africa and to a lesser extent Egypt. This report suggests that investing in Africa's equity exchanges alone may not give investors the required exposure to the growth sectors in these markets. The Bright Africa report covers the equity investment alternatives available to investors with a focus on transaction and quoted multiples as an indication of the relative price of African equity. These multiples were compared with other parts of the world, as we saw, and with different regions on the continent. Given the challenges of listed markets, investors with a long-term focus are looking to private equity to supplement their African equity exposure. While private equity certainly has its own limitations, it has the great advantage of being able to access companies that are outside the confines of listed markets, giving investors wider exposure to sectors and to companies at different stages of development as well. What this report concludes is that, number one, private equity deal multiples in Africa, outside of South Africa, are on average higher than South African deal multiples. And I didn't quote the number in the previous chart, but on average, deal multiples across Africa, excluding South Africa, are around 6.8 times, whereas in South Africa, they're around 6 times. And number two, private equity deals in Africa use significantly less debt. I think that was clear, that came through in the analysis. Number three, the use of debt in African deals has not yet recovered post the financial crisis. 4, deal multiples in African private equity are lower than listed market multiples across the different regions of the continent, with the possible exception of East Africa. And number 5, private equity deals in Africa take place at lower multiples than deals globally across all deal sizes. That was the 12% discount that we saw across the board. So in practice, many investors are using a combination of listed and private equity investments to fill their African equity allocations. And this is expected to continue for the foreseeable future as an effective way for investors to gain exposure to Africa's exciting growth potential.